Welcome to Orange County Power Players, where we spotlight the personal, professional, and financial success stories of OC's top leaders. Here's your host, Danny Flores.
Welcome back to OC Power Players, where I interview some of the most successful people in Orange County and outside, because today's honored guest is Ginny Bolling from Florida, and she's going to be our guest today. I'm your host, Danny Flores. Now, with Ginny, she's a seasoned real estate professional syndicating commercial real estate investments with lifestyle-oriented people looking to build wealth, cash flow, and get tax benefits while improving communities. She is pickleball, tennis, and equestrian fans are especially suited. Yes, others too would say golfer, but she doesn't speak that language. Appraisers, land planners, and attorneys are also very well suited, and she speaks their language. She's a buy and hold investor, lender, and former flipper. Welcome, Ginny.
Thank you very much.
Tell us a little bit about, for the people who don't know what syndicating is, tell us a little bit about what that looks like for you.
Well, this is a great thing to start with, actually, because I'm just getting back from a conference where I was meeting with all of these real estate experts, my peers that have appraised property and negotiated acquisitions for government their whole lives, and they don't know what syndications are. So most of them, for the most part, they don't truly get it. They know syndicating is like sharing, but that's as far as it goes for a lot of people. You know, syndicating athletes and syndicating newspapers and all that is kind of a way of looking at it. But truly, the way Harvard Business describes it, it's just a pooling of resources, whether it's skills or money, whatever. It's just a pooling of all that. And so I've been explaining that a lot this last week.
Wow.
So it's highly papered, the way I describe it. It's just a joint venture on steroids where you have put into writing the details about the operating agreement, who the operators are, what they're going to do in certain situations, and the business plan, and they're combined along with the legal disclosures and whatnot that are required to make a private placement memorandum. And it's not mandatory, but if you're going to go into a syndication, you should look for the private placement memorandum and be sure you've read the whole thing and you like it. Before you invest, you want to like the plan. So that's what a syndication's about.
Right. So now let's take one step back for somebody. So now you gave them an idea of what syndication is in what you do. How does it apply? What kind of assets are you buying?
So for us, we like multifamily because there's still a great shortage of housing and everybody needs somewhere to live. So there's multifamily, and then medical office in the markets that I'm in, they are in high demand. And it tends to be across the board US because of the baby boomers now reaching a critical point. The silver tsunami has begun. So there's a greater need for medical offices. And then I love industrial. I've always loved industrial. Ever since the 1980s when I was an appraiser, I knew right away I liked industrial because that's kind of the backbone of America. And with the reshoring of so much manufacturing and distribution in our country, warehousing, industrial is doing pretty well in most places. So those are my three things. And so we try to find a deal that can handle and perform well for investors after we do a great deal of due diligence. If it meets the criteria, then we offer it to investors. And we need our LPs. The limited partners are what give they make or break it, basically.
Now, so you mentioned three asset classes: multifamily, medical office, and industrial. What kind of returns get you excited that you would take a deal to the investors?
So typically we're looking for an internal rate of return in the mid-teens. Much depends on the property though, because for instance, if you are investing in something that needs a lot of capital improvements, then most of your return is going to be on the back end when you're done with doing the capital infusions. And so it might not be a lot of cash on cash or distributions in the beginning. The internal rate of return, though, will reflect the total in the end, or an annual rate of return. So they're a little different, but the internal rates of return, you have to be over 12% almost without saying to attract investors. And we usually are looking at 15, 18, ideally higher, but the standard is really going to be 12 to 18% in deals like these. And we'd like to hit the middle of that.
Now, do the three different asset classes that you pursue give returns within that range, or does one tend to be higher than the other?
Yeah. So it's property specific. Yeah, it just depends because if you yeah, on a generalization, I wouldn't want to generalize.
No, so no set rule. It depends, right? It depends on the
Yeah.
property,
So I'm
the
one of those
deal.
though too. You asked me about cap rates and I say, well, how are you going to compute them? Because so many people really, I
Right.
mean, yeah, I don't generalize much.
Yeah, no, I get it. I get it. I get it. Now, how about financing? What does financing look like nowadays? Because it changes from year to year and even from quarter to quarter, depending on where the interest rates are, depending on the appetite of the specific lenders. What do you see today that is attractive or at least worth talking about?
Well, typically we're looking to do agency financing and somewhere in the 60 to 70% range. We don't want to over leverage. We've never been big on floating rate debt, although there is a place for that. The floating rate debt, though, as you know, is really what's been kind of a problem for a lot of these prior developments where people were projecting too aggressive rent growth. But in any case, the way that we like to look at it is to lower risk and to do a lower loan to value and raise the capital for the difference.
Okay. Now, I heard some of these properties can also have tax benefits for investors. Tell us a little bit about that.
So the real exciting thing is the new legislation in that big beautiful tax bill is supposed to and hopefully it will give us an accelerated depreciation and bonus depreciation again. That was a big plus for investors the last several years, but it sunsets January 2026. So it's been a step down process over the last several years where we had a great deal of depreciation. So for instance, when someone invested, say, $100,000 into some of the deals the last couple of years, they may get 60, 80, or 100 back in depreciation, a paper loss. So that's really been exciting for a lot of people to learn how depreciation can be the magic.
Right.
So it really is.
Yes. Now, there's two kinds, and maybe you can explain. There's your regular straight line depreciation, and there's your cost segregation study.
Right.
How does one benefit more, benefit the investor more versus the other one?
That's a great question. I just had a roundtable meeting. We do a monthly meeting, and I have a speaker, and I had a fantastic expert on cost segregation come on, and he's local to us in Orlando too, so that was even better. And basically, what it comes down to is you take a property, and instead of just doing an average depreciation over the years, over the expected life. So for commercial property, 27 and a half years, then what you can do is you look at the shorter lived items like the carpeting, the window treatments, the flooring even, and some other things that are not going to live that whole 27 years. Water heaters, lots of components, most components of a building really have a shorter life. So those can be abstracted by a qualified expert, somebody that knows how to do a cost segregation. They put it into a report. They have an engineering background, in fact, to even ensure that it's being properly done. And then they will come up with the calculations to show what the shorter lived items would be. It might be that they have a 5, 10, 15-year life. I think it's 5 or 15, but in any case, versus the longer live. So when you've got the bonus depreciation too, you can capitalize even further on that. But so the costs, I don't want to confuse it. The cost segregation lets you separate the building components and equipment. I mean, there's a lot of fixtures in some types of properties, especially the industrial.
Mm-hmm.
So
Mm-hmm.
so a lot of people wrote off a lot of the income the last few years because of that.
Wow, that's a great tax law to have, I think, and hopefully with the bill, I think it's in the Senate right now, passes and we get that back for everybody's sake, right? And nobody likes to pay taxes.
A couple other things. So you asked me about the tax benefits. That's not the only. Depreciation is one of the magic things, but there's a
Mm-hmm.
couple others. There's tax abatements and there's tax different types of tax credits.
Mm-hmm.
Some of it for sustainable and energy saving types of things. But the other is also for affordable housing. Different states have different programs where you can either
Mm-hmm.
abate, defer, or in some cases, there's forgiveness and opportunity zones. Every
Mm-hmm.
state has opportunity zones, and that sunsets also October or January 1st, 2026, but is planned to be extended. Um, you can take capital gains out of one uh, project and put it into an opportunity zone fund, meaning you're buying a property that's in an opportunity zone and a
Mm-hmm.
fund has been created to accept the monies. And then they
Right.
go and fix up everything that's related to that property. And if you hold it for 10 years, you never pay taxes on those gains.
That's a very good tax incentive there.
Yeah, it
A
is.
10-year hold and not pay taxes. Why would you not invest in real estate?
Yeah.
Right?
Yes.
So you're out in Florida,
Mhm.
and Florida has hurricanes, and the insurance companies don't like that. How is the insurance cost affecting the buildings that you're buying?
Well, it truly is difficult to get things to pencil at times. The rates have come down a little bit. They have tripled in the last 5 years, though. Part of that was because we had a lot of fraud. We had more fraud in Florida than anywhere else in the country. I got involved in going up to Tallahassee and lobbying for the legislators to change some of those laws because what was happening was um, there were a lot of roofs getting replaced, claiming damages from storms that really it wasn't from that. That's part of it. And the bigger part of the payouts were going to the attorneys, not even to replace the roof. So we've changed some of that, and that's helping to contain some of the costs, and premiums have come down a little bit, but there's more to go on that. So yeah, that's a big problem. But guess what? We still are in paradise.
Yeah, I hear you. I hear you. We're
Everybody wants to come
not
to Florida. Yeah.
with the
So
other
we have great
paradise
weather.
state.
Yeah. And it's
Yeah.
still growing like crazy too.
And so now we know that you probably don't buy every deal that you see. How many deals do you have to see to find the one that you say, you know what? I like this deal. My investors would like this deal. I can get this deal financed and I can make this deal work. What does that
Over
look like?
75 and closer to 100 deals, just like you hear people say, it's really a ridiculous number of properties we have to look at to find the right ones. I mean, you
Uh,
get so that you could be faster with some of it, but it is a lot of looking. And I
yeah,
look mainly in Florida, but there's other places as well. Yeah.
right. So are you guys vertically integrated? And what I mean by that is, do you guys have in-house property management, in-house maintenance techs, or do you guys hire third-party managers? How do the operations look like when you do an acquisition?
So we prefer to have third-party property management, people that are specialized in that particular market.
Mm-hmm.
The reason being they have the systems and the knowledge for that particular market. Oftentimes
Mm-hmm.
it's not right here in my backyard, you know. I'm in Houston, I'm in Jacksonville, Birmingham. We typically want to have somebody that's extremely knowledgeable on that market, and then we oversee them and have an asset manager that's interfacing with them, making sure that they're staying on schedule and doing all the things that are required for the business
Mm-hmm.
plan to be properly implemented. And we'll train them if need be, but yeah, we're not integrated in that way. And as far as the construction, if there's renovations and a heavy amount of CapEx for fixing up the property,
Mm-hmm.
then we are apt to pick a property management company that already has a good working relationship and a good cost structure
Mm-hmm.
for doing those renovations quickly.
Wow. So basically, you're like you're able to find the deal, decide to do the acquisition. You go out and you raise the money from investors, so you put that together. You get the financing done, close the deal, operate the deal, and give the investors great returns. That's like a winning formula right there. Now, how long is your usual hold period?
I like to say it's the best thing since sliced bread because it's hands
Right?
on. You can do this and be hands off. Um, the hold periods are usually 5 years roughly, but depending again on the type of project, we're
Mm-hmm.
usually looking to do a refinance somewhere in that 3 year anniversary,
Mm-hmm.
because a lot of investors want to get some of their money back. And if it's really performing well, like during COVID, there were properties that met their 5 years in 18 months. They were performing phenomenally for a while there, as you know. And so yeah, if there's a possibility to sell and have the investors meet their expectations, meet or exceed, then we would have a discussion on it and very possibly sell sooner. But typically, you've got to expect 5 years or 7 years, whatever is in that business plan. You always got to look to the business plan, though.
Right. Now, what if there's a sudden turn of events where the say the interest rates don't cooperate? What would you do? Do you extend the 5 year hold a little bit longer, or do you refinance, or what does that look like? Just in case, you sometimes things can happen, right?
It does. And yeah, there would be provisions, also discussion in the business plan about how that would be handled, because we want the limited partners, all partners, to understand what might happen in cases like that. And
Mm-hmm.
typically it does mean to hold it a bit longer. Now,
Mm-hmm.
for instance, in current situation, most people thought the rates would have been coming down by now. And it can become a problem. And as you see now, there's some investors that are selling because they had to. They locked themselves in, and
Mm-hmm.
they're in some cases taking a loss. So
Yeah.
you
Yeah.
always want your general partners to be able to flex with the time
Right.
of the event in the market.
Right. Well, as we wrap up our interview, what do the next 6 or 12 months look like for you?
Oh, exciting, I think, because of all those people that overprojected and that had floating rate debt. There's a lot of distress in the commercial real estate market. And I think that this is kind of a cleansing period we're in, and it's a correction, if you will, where some of the prices have come down. And I, the last several years, was having a hard time justifying the prices in many instances. They got just too high.
Mm-hmm.
People can't, and especially here in Florida, a lot of people can't afford to live in their communities because the rents got so high. But now
Right.
there's a correction going on, and the market laissez-faire. I'm a big believer that you got to let the market do its thing. And so I think that there will be some really good deals out there the next 18 months, 24 months.
Mhm.
And so you just have to be patient and really check these properties out. And so I'm trying to get my people to be on standby to understand and prepare so they can pull the trigger, because sometimes if it's a really good deal, it might go too fast and then they'll miss.
They do. They do. Well,
And I
Ginny,
will also add this, being in it for 40 years, I have seen a lot of ups and downs, and I've missed a bunch of downturns, and I am not going to miss this one. So I'm trying to make sure all my peers that are in their
there you
60s
go.
are going
There
to
you go.
get
Right.
ready.
Right on, Ginny. Right on. Well, Ginny, thank you so much for joining us and sharing your expertise in the field. If somebody wanted to get a hold of you, how could they get a hold of you?
So I'm pretty visible on social media. LinkedIn is my preferred platform. So I'm under Ginny Bolling, GINNY BOLLING. I think it has my maiden name, Graf, GRAF probably. But then I also can send you, for instance, my email and whatnot to perhaps put into the show notes. And I'm at Pivotal Real Estate Investments, and that can be looked up at just pivotalrealestateinvestments.com.
Very good. Well, Ginny, thank you so much for joining us. And to our audience, please go to ocpowerplayers.com and follow us on your favorite channel. Thank you, Ginny.
Thank you. Appreciate it.
Thanks for listening to Orange County Power Players. Want to share your success story? Apply to be a guest at ocpowerplayers.com/guest.